So today we're going to talk about the current short sell attack that is going on Sofi stock, and as well as that we're going to talk about the market drop in general because it has been an ugly start to the year. I was starting to get flashbacks to 2022, but thinking about that, we needed 20. If you've made it through that 2022 drop, then you're not even flinching at this drop at the moment. You need a 20% drop to even flinch on there. But yeah, I mean, it's been a bit of a tough start, hasn't it, so far this year? I think personally for me, I think my account's down about 4%. So we'll be looking at what's going on there as well. So hope you enjoy the video. Let's get started. Now, just a quick shout out. I did drop a live Q&A session yesterday. It's around about 53 minutes long. So if you can put up with me for 53 minutes, then go watch it. It's just a thank you for getting me to 15,000 subscribers. So thank you for all you guys that do like the video, subscribe to the video, comment on the video, and the support on the channel for the last few years. And as well as that, if you want some free shares, join Trading 212 with the link in the description. Join through there, you can get a free share worth up to £100. That's the broker that I use. So if you are looking to switch brokers or maybe start investing, that's the platform that I personally recommend to use. So the S&P. So the S&P is down 1.4%, which you're thinking, that's not too bad realistically. When you look at the Nasdaq's getting a little bit hit heavier than that. It's down 3.1%. So obviously with the S&P, you would expect if the S&P is down, the Nasdaq to be down more. That's just generally how the market tends to work. Same as when the S&P is up. You would expect the Nasdaq to outperform. That's what we've seen in the last year. S&P is up 22%. The Nasdaq, when you look at that, it's still up 49% in the last year with the dip that it's currently on, which is pretty impressive. Now, first of all, I wanted to mention this in today's video. JD Sports, if you wanted to ever have an example of how reactionary the market can be, it's the drop on JD Sports today. The stock is currently down 23% and they came out with a profit warning. So fair enough, if you're going to come out with a profit warning, you could probably expect a drop in the stock. Now the profit warning that JD Sports has given, I'm still trying to figure out how it's dropped I'm still trying to work out how it's dropped double digit. I can understand a single drop in the stock price, not a double digit, and it shows you how crazy the market can be sometimes. Now, we know that this space, if you look at Foot Locker, Nike, it's having a tough time at the moment with the economic impact. JD Sports, it's managed to survive it, but it's been caught up in it now. And as well as that, we've seen the UK as well go a little bit weak on an economy point of view. So it does make sense that JD Sports has now joined the rest of the group having a bit of a weak trading time. Now, when I say weak trading time, I don't actually think it's that bad. You know, you look at the numbers that they've had here. If you look at revenue growth was still 6%, and for the full year they're still expecting 8% revenue growth, which is still pretty impressive. A lot of companies wish they were growing 8% year over year. They said that they have seen bigger discounting going on. That's probably because all the other companies are struggling, that finally it's caught up with JD Sports. So this isn't going to be something that lasts a long time. They're seeing gross margins are going to be in line with last year, but that is lower than their expectations, which still isn't that bad. And you can see here that they're saying that for the full year, they're now estimating profit before tax to be between 915 to 935 million. Now that's profit before tax. I mean, at the end of the year, what will we come out with? I don't know. But if you look at the valuation at the moment, so you've still got a company that in this tough time is going to grow 8% this year. Gross margins, sure, they're not increasing, but they're still okay. And the profit is still going to be 915 million to 935 million profit before tax. And then you look at what the company is valued at, and the company is valued at 6 billion. That's insane. Like, the company is still growing at very good rates, and on a valuation point of view, this is still going to be dropping down to at least 9 times earnings. So you're paying for a company that's done these numbers in this tough time, 9 times earnings. It's insane. And then you're getting a 22% drop off these numbers. It's absolutely crazy. So many companies wish they were still doing these numbers, and these numbers are still very good numbers, and yet it's down 22. If you ever wanted to see how crazy the drops could be on the market, you know, they say that the bulls take the stairs and the bears take the elevator. That is a perfect example of what's going on. If they came out with these numbers on the opposite side, on the higher side, I could tell you the stock would not jump up 22%. So yeah, I think that is a standout buying opportunity for a very high quality UK company that is currently going on in the market today. Apple stock. So Apple stock is joining in with the market on its downtrend. It's down 4%, and it's actually good to see Apple dropping more in terms of what the market's dropping. You look at the S&P down 1.5%, the Nasdaq down 3%. It's good to see Apple actually dropping more than that. And it's good to see Apple actually having a reality check on the share price, but it's showing you those individual stocks are getting a little bit hit harder, especially like Nvidia, for example, that's down basically 4%. But it's also mean that, as I always say, if the S&P and Nasdaq is up, I expect to outperform the market, which happened last year. When the S&P and Nasdaq is down, I expect to underperform the market, and that's exactly what's happening in these last couple of days. You look at the King, having a bit of a tough time at the moment, that's down 9% and being the big contributor to why my portfolio has performed badly in the last few days. Hims and Hers, even with a good day on the 2nd of January, had a good pop. It's given it all back, and that had a pretty nasty pullback yesterday. If you look at Mercado Libre, for example, that's down 4.8%. So that's getting hit hard. Now, obviously, is there a reason for this? Is there a reason for why these stocks in the market is having a drop? There's a few things. I'll take you through a couple of them. The first thing is the market in general. We had the best stock market since 2019. It was a great year last year. And as much as we really liked looking at all the stocks last year and looking at DraftKings going up 175%, as much as we love seeing Hims and Hers up 36%, as much as we love Mercado Libre being up at nearly 80%, it can't happen forever. There's got to be a cooling off phase. And I know people don't like me saying this, but it is actually, I am liking the drop at the moment. First of all, it'd be very nice to have some buying opportunities. But the second part is that it's good to have a cooling off phase. We just can't keep going up and up and up. If we keep going up and up and up, valuations will get stretched and it will correct. That's what we had in 2021 and it really hurt. And we don't want to get to that point of view where markets get a bit too overheated. So to have a break now is good. And I know people don't like me saying this because everyone enjoys going on their account every day, seeing the stocks are up, and it is nice. But honestly, from my point of view, it would be very good, and I hate to be the bearer of bad news here, it would be good to see the stock market this year have the first 6 months doing nothing. It would be very good to see the S&P doing nothing for the first 6 months of the year. It'd be okay to see it go down 3, 4, 5% this year at the start of the year. It'd be very good for the market to have a bit of a cooling off phase after the rally it's been on. Very healthy. So we've got to accept that we've had a good run. It's good to have a pause. It's healthy for the market. And the other thing as well is that we're in a new year. And when a lot of investors, a lot of analysts, a lot of the investments that are being made, people are going to be looking now and going, oh, I had a really good year in DraftKings. I had a really good year in Hims and Hers, Microsoft, whatever. You could even look at Nvidia and Apple. A lot of people are going to be looking at going, I'm going to take a bit of profit off the table as well. So you've got to accept that it's good to have a cooling off phase, and there's going to be a little bit of profit taking after the year that we've had. So that's one reason that we are probably having a little bit of a downturn at the moment at the start of the year. The other thing is there's been a little bit of an adjustment in the background, so you probably won't see this mentioned anywhere else, but I always like to keep interested in it. So in December, we had the Fed come out. The Fed basically said, yeah, we're going to do some cuts in 2024. Now, you guys would have seen my video in December. Basically, the market was expecting cuts in 2024. So that wasn't a big jump, a big surprise to the market. What happened then is that the market went, okay, so now we're going to expect cuts to happen in March. Only 3 months away, or you could say 2 months away now. So then the market started expecting cuts to happen in March, which is totally opposite to what the Fed was saying, and the market were getting once again a little bit carried away, a little bit forward thinking of where the Fed actually were. And now what's happened in the last few days is the market's actually going, we might not get those cuts in March, and the market's readjusting to getting a bit carried away with the Fed cuts. So that's something else that's been likely going on in the background as well, that's probably not mentioned in many places. Other thing is the Red Sea crisis. This is probably the one that a lot of people are pointing to at the moment, and this is true. Obviously, the big thing we're seeing is shipping firms are avoiding going through the Red Sea. They're taking the alternative route through Africa, which does take a little bit longer for goods to be delivered, and that's causing a bit of issue. Now, the big issue that this will cause, and I don't think it's a big issue, but it's certainly something to keep an eye on. And the reason why is because when you look at the shipping costs, you can see here that they have doubled in the last couple of weeks because of this. Now, obviously, when the shipping costs then double, the knock-on effect is inflation. Now, the big thing is that we are wanting to see this year to have a good year is the cuts, and the cuts are only going to happen is if inflation keeps going down. Now, something like this could disrupt the inflation, which is what we don't want to see. So it's definitely something that we want to see resolved. However, it's not the biggest impact on inflation, but certainly if you remember in 2021, the big thing that did start the inflation spike off was the rise of shipping containers, if you remember. So this is something that did start the last spike of inflation, but it's not the biggest cause of inflation. If you remember what caused the big spike of inflation last year was oil. Oil went absolutely crazy. If we zoom out a little bit, oil went absolutely crazy, caused mass amounts of inflation, but however that's staying a little bit lower at the moment, which is really good to see. So that's more important, because if oil and cost of fuel keeps going up, that's the knock-on effect for inflation. So it's bad news, but it could get worse if this starts going up. So that's the key thing to be looking at. So that's probably one thing that's causing a little bit wobble on the market at the moment. But I feel like this situation probably will get resolved, and hopefully we see a few nations coming together to put a little bit more security out in the Red Sea, and hopefully this story disappears in the next coming 3 or 4 months. We'll see what happens. But let's go into Sofi stock, because Sofi is the main title of the video anyway. So Sofi, being a good performer in the last year, one of those good performers. You can see here the stock is up 74% in the last year, and that's including the drop that we had yesterday, which was basically nearly a 14% drop on the share price. So still a very good year, even with the drop that we've had in the last day. Now obviously I'm a Sofi shareholder, and first of all the key thing is what caused the drop. Now if you ever wanted to have an example of how stupid the stock market can be, this is why the stock dropped 14%. There was a downgrade by an analyst, KBW, and yes, I said the same thing. I have never heard of KBW, so I don't know how they have the ability to cause a 14% drop, but it is happening, so it's absolutely crazy. But basically they came out with a share price target, and their share price prediction was $6.50. Yeah, you read that right, $6.50. So that's from, obviously without the drop, that would have been from $9.65 down there. So that was a big drop on the share price. And they're kind of suggesting it will go back to prices that we haven't seen since around about mid-2023. So they are expecting a big pullback. Now, the big thing is that you see this $6.50 share price, they underperform on the price target, and their previous target was $7.50. So they're basically saying since they last looked at the stock, which was 6 months ago, they have come to the conclusion that the stock should be actually lower than 6 months ago. And if any of you guys have actually looked into Sofi stock, which I'm sure a lot of you have, they have done nothing to deserve a lower share price from where they were 6 months ago. If you look at the recent quarters, the EPS is a beat, the revenue was a big beat, they've been upgrading the guidance. So they've come out with some triple beats in that time frame, and yet this analyst, KBW, has then downgraded the share price from $7.50 to $6.50, and it's down 13%. So it just doesn't make sense, does it? It doesn't make sense why the share price has dropped so much off an analyst you'd never heard of that had a shocking price target 6 months ago. The stock has done triple beats since then, and then they've lowered the share price a little bit lower. So that's where me, a little bit of a research here, came in to see what's kind of going on here. Is there a little bit more going on behind the scenes with Sofi? And there is. So you can see here that on the 1st of August, they put an underperform target on it once again. Now the last time they did this was on the 1st of August, like we said, and if you look at the share price on the 1st of August for Sofi, look at where it was. It was at 52-week highs, and they caused the stock to go down on this downtrend. Now, once again, they bring out another downgrade on the stock, and where was it? It was very close to breaking 52-week highs. So do you think this is accidental that they're bringing these downgrades at 52-week highs? Or do you think there's a coincidence they're doing it? And there is. I'm sure most of you have been aware of this. I've spoken about this before. Sofi is not popular with the big banks. And you can see this interview that Antinoto did 3 months ago, is he basically came out and said, we're stealing share from the big banks. And obviously, the big banks don't like that. They don't like the new kid on the block coming in and taking customers away. Now, there's not much they can do because they've got an inferior product, and Sofi will continue to take market share from them. But there has been an increased short positions on Sofi. Now, why is there increased positions or short positions on Sofi when you've got a company that is bringing out financials like this? Well, if you're the big banks and you're seeing your market share getting taken away by this company and you go, well, there's not much we can do from a competitive point of view. They're better than us. But if you're a big bank, what do you have? You've got the money. So you can be a little bit clever and go, okay, you might be taking market share away from us and delivering these financials, but you know what we can do because we've got the big money? we can control your share price. And then when you look at someone like a KBW that then brings out this price target and then you see this big selling off, who has the money to do that? And why would KBW be supporting this downgrade on this stock? Well, when you start looking at KBW, look at what their top 10 holdings are. JP Morgan and Chase, 8%. Bank of America Corp, 8%. Goldman Sachs, 8%. Morgan Stanley, 7%. So they have big ownership in the big banks. So when they've got the big ownership in these banks and the big banks are not happy about SoFi taking market share away, do you think it's a coincidence there's maybe a little bit of teamwork, all that money coming out of SoFi? Who has the big money? The big banks. Who do KBW have big investments in? The big banks. Are you seeing the crossover a little bit going on here? I think so. So unfortunately, we've seen this with SoFi. It happened a few months ago in the summer of 2023. It looks like we're seeing the same thing happen again. There is a big coordinated attack going on SoFi. And unfortunately, even though we should not see drops like this in SoFi when it's a company that's been putting up these financials in the last couple of years, unfortunately, when you're upsetting the big boys a little bit, that is going to take its toll, and there's them little bit of attacks taking on SoFi at the moment. Now, personally for me, I won't worry about it. I think it's just a lot of BS that's been allowed to go in the market. You know, we see it all the time. We see it with short reports. We've seen it with SoFi. We saw it with JD Sports today. There is BS that goes on in the market, and we are seeing that with SoFi, and it is frustrating. But ultimately, I think, hey, you know what? If this is going to lead to me having a buying opportunity in the $6 and $7 range again, I'll take it. Because in the longer term, the main thing SoFi has to do is do these financials. And if they do these financials still, they will get rewarded on the share price. Granted, it's frustrating when these drops do happen on the share price, but at the end of the day, from the long-term point of view, the stock is still up 74% this year, which is still relatively very good performance. And it will get the right valuation on the share price if it keeps doing the right financials. And that's the most important thing. So unfortunately, when you are in the stock market, you have to take some of this BS that goes on in the market sometimes. And that's what we're seeing right now. But in the longer term, it should resolve itself, and hopefully the share price does carry on performing the way that it has been doing anyway. Hope you enjoyed the video, guys. Hit that like button. If you're not here, subscribe. I'll see you in a bit.